Hi, everyone. So my name is Leen Ajlouni. I am an investment associate at North Coast Ventures. I'm going to click present and hope that you can see the presenter mode. So I'm very excited to be here. I'm very honored that I was asked to present and talk with you all. It seems to be a great group of students, ambitious, smart, and aspiring entrepreneurs and investors. So I couldn't be more excited to be here. I wanted to make this conversation as engaging as possible, so I'll occasionally see if anyone has any questions. At the end, definitely I'll leave 10 minutes for any questions or topics that you'd like me to speak more about. And just a disclaimer, so my presentation is called Everything VC, but I have just been in VC for the past 6 months, so I'm still fairly new. So I'm going to speak from a very humble experience, and I hope that this will be helpful. So my objectives for this presentation is to provide you with a foundational background on venture financing and the 3 classes of early stage investors. I'd also like to give you insight into what VCs look for, the VC funnel, and why most startups fail. Also introduce you to North Coast Ventures, which is in our backyard, a seed stage angel fund / venture fund here in Cleveland. I would also love to share with you what the path to VC looks like, if there is a path, and of course, get the opportunity to answer any questions that you have and provide you with my contact information if you'd like to engage further in the future. So I wanted to first ask, what is the difference between an angel investor and a venture capitalist? I don't know if people can participate. Let's see if anyone can write something in the chat, but would love to see if anyone has any thoughts about what the difference is. All right, I'm going to go ahead. I don't see any responses in the chat. All right, so very simplistically, an angel investor is an individual. Typically, they have under $1 million investments. They usually have another full-time job. They're not really willing or interested to get involved with the company very actively. They're usually not going to ask for a board seat. Their objective is to really bring the product to the market. So they're going to be willing to serve as mentors or connect the entrepreneur with resources. And really, their vision is to invest in the long term. So their timeline is almost 7 to 10 years usually. So they're looking for high returns, and the timeline is usually 10 years. For venture capitalists, they're usually investing on behalf of a company or behalf of a fund. So they usually invest above $1 million. This is their full-time job. This is what they do for a living. They usually do require a board seat, so they would like to serve in a board seat on the portfolio companies that they're investing in. They may, or they actually do want to get involved with companies, typically want to have capacity in the governance structure. Their objective is to scale the existing offering, and they're looking for a large return on investments, a similar kind of time frame, usually 7 to 10 years. So there are 3 classes of early stage investors, and those range the spectrum of risk, return, and stage of business. You probably all know the 3. They're angel funds, venture capital funds, and private equity. Angel funds usually are pre-revenue. Usually they don't have customers. They have a well-developed business plan. They invest in companies that have a prototype. If they have customers, it probably has a very minimally viable product. Venture capital funds usually invest in companies that have a proven revenue model. They want to see clear financial projections. They would love to see a rapidly growing customer base. And again, they want to see a clear revenue strategy, clear financial projections, and a very strong revenue model. Private equity, on the other hand, usually invests in companies that are beyond generating revenue. Usually those companies have developed profitable margins, they have stable, positive cash flow, and usually they're able to service a significant amount of debt. So to get into the weeds of those differences a little bit more, so angel investors, usually they invest in, again, companies that are typically pre-revenue. The size of their investment usually ranges from $10,000 to a few million. The type of their investment usually is equity, increasingly more convertible note than safe. The investment team usually is made up of entrepreneurs, past founders, even more so than that. The level of risk usually is extreme risk. So they're looking for high risk, but high returns. So there is a high chance of losing all your money. The return profile usually is 10x. That's kind of the return target. Industry focus really varies from firm to firm. What the screening process really looks at is they're looking at the founders, they're looking at the market, the total addressable market, they're looking at the potential for market share, the virality, the number of users, and more. Some examples of that you probably are familiar with are the Y Combinator, Techstars, AngelList, and more. Venture capital, on the other hand, usually invest early stage, typically companies that have revenue, maybe before profitability. The size of their investment usually varies, usually a few millions to tens of millions of dollars. Type of investment, again, same, equity, convertible debt for the most part. The investment team usually is made up of a mix of entrepreneurs, bankers, finance, people with that kind of background, even more than that too. The level of risk usually, again, is very high risk, moderate chance of losing all your money, but high risk and high returns. Return profile is similar to angel investors, usually around 10x. Industry focus, again, varies from firm to firm. Screening process, they look at the founders, they look at the market share potential, they look at the revenue, the margins, the growth rate. And then examples of that are Sequoia, Vantage Point, Highland, North Coast Ventures, and much more. Private equity usually invests in mid to later stage. Those companies are definitely profitable. They have positive cash flow. The size of their investment is usually a few $1 million to $1 billion even. The type of investment is equity with leverage. Investment team, usually they are made up of mostly bankers, people with finance, investment banking experience. The level of risk usually is moderate risk, low chance of losing all your money. The return profile is typically 3x plus. Industry focus, again, varies firm to firm. What they look for in the screening process is the EBITDA, the cash flow, the IRR, the financial projections, amongst many. And then examples of those are Carlyle Group, Blackstone, Apollo, KKR, and more. So now that we've mentioned the full spectrum, a lot of people wonder, why does the venture capital industry exist and how does it work? So the venture capital industry really has four main players. It has entrepreneurs who need funding. They typically have great ideas with high potential, but they need the money to bring them to the market. Sometimes they're backed by corporations and government who have even given them support or given them grants and funding. Then you have the private investors who have the capital and have the time, the patience to invest their capital long term, but are looking for high returns. You also have the investment bankers who need the companies to sell. They work with public markets and corporations to exchange money for stock. And so you've got this market, this prime market for venture capitalists to make a business out of this and make money for themselves by making a market for all the other three stakeholders in the industry. So what does a typical fund structure look like for either a VC or a private equity fund? Usually you have the investment professionals, which are the general partners. Those are the people who do this for a full-time living. They manage the funds. The motivations behind those individuals, aside from getting a salary, is carried interest and management fees. Usually carried interest are around 20%. Management fee usually is 2% of the fund. Then you've got the limited partners, who are the investors. Their motivation is the capital interest. They're willing to put in the capital in exchange for high returns in the long run. So together you create this venture capital fund, which is a limited partnership. This is managed usually by the general partner, who evaluates companies and evaluates which companies the fund should invest in. The companies that the fund invests in become the portfolio companies. So that kind of typically is the structure for how your average venture capital fund looks like. So who can invest in startup outside of crowdfunding, of course? So based on the Securities and Exchange Commission, there's something called the Regulation D, which generally is available only to accredited investors. So who are those accredited investors? Usually those are individuals with net worth that exceeds $1 million. That does not include their primary residence. Also, or it can also be somebody who has income that exceeds $200,000 each of the last 2 years as an individual, or jointly with their spouse has an income that exceeds $300,000 again each of the last 2 years. So you might be wondering, does Cleveland have active angels? To put it into perspective, the United States has 4.2 million millionaires. 1 million of those are informal investors, and 1/4 of those are active angels. If you look at an average Cavs parade, one that happened a couple of years ago, for example, there were 16,000 millionaires just in that parade. 4,000 of which were informal investors, and by that I mean they are accredited investors that are just not actively engaged right now in investing, and 1,000 of those are actually active angels. So just in your typical Cavs parade, there is an average of 1,000 active angels. So yes, Cleveland has a good population of active investors or angels, and of course that is not only in Cleveland but also in Ohio and the Midwest region as a whole. So demographics of you as venture capitalists. Who are venture capitalists? As you might expect, 82% of venture capitalists are male. Only 18% so far are female. 70% are white, 26% are Asian, only 3% are Black, and 1% is Hispanic. And this might be interesting to some of you, but in terms of the college demographics, 40% come from Stanford or Harvard, which to me was very surprising, and only 60% come from other institutions. So for those of you in the audience who are aspiring investors, and you're graduating from CASE, go ahead and be one of those trailblazers who are paving the path for people who are not who come from similar demographics as your average venture capitalists. As for angel investors in the US, from the gender perspective, usually they're more diverse than venture capitalists. Typically, around 22% are women. Increasingly, we're seeing 30% of new angels are women. In terms of race, same thing, really highlights the racial gap that exists. Around 88% are white. 3% are, around 1.3% only is Black, 6% is Asian, 2.3% is Hispanic, and 3% is other. So pretty, racially divided. And then in terms of the age, the mean age for first investment is usually 48, but it really also ranges the spectrum. So in terms of venture capital investments by region, you can see here there's a huge discrepancy between venture capital investments on the coasts and everything between the coasts. So Silicon Valley alone has $11 billion investments just in the past year. New England has $3 billion. New York by itself has $119 million investments. Then you take a look at the Midwest. The Midwest only has $1.4 billion investments in the region just in the last year. So there's really a huge divide between what's available in terms of capital on the coast and what's available or accessed in between the coasts. And to take that point home, Boston, for example, had 10.1% of the total US VC investments, while the Greater Lakes region had only 4.3% of the total in a given year. So again, there's a huge disparity in the dollar value of deals that come in between the coast and the Greater Lake region. So you might be interested, which industries do VCs invest in the most? What are the most attractive industries? And just to give you kind of an example from the past year, 36.2% of investments in venture capital were in software. Typically, those are business-to-business software. 17.3% was in biotechnology. So those are kind of the two biggest areas or niches for venture capitals. A lot of firms are actually specialized in biotechnology and life sciences. Then you've got a lot of others, as for example, medical devices. You've got media and entertainment, IT, telecommunication, consumer products and services, industrial energy, and much more. And this is just for the US. So if you go to other geographies or regions, for example, the Middle East, a lot of it is focused on e-commerce. So it really differs based on the region. So you might be currently an entrepreneur, or you might be in the future looking to be an entrepreneur. At some point, you will be seeking cash, and you're going to be confused as to where you want to go. So this is just very simplistically a visualization of, based on your needs, which direction to take. So most startups need either cash, support, or both. If you need cash, and that's just at the beginning of your development, so if you've got a concept, if you've got a prototype, you just need the cash to go out in the market to test it, to have a beta pilot. There are 3 avenues that you can take. One is grants. So those are competitions, those are federal grants and much more. You can also do reward-based crowdfunding, or you could do equity-based crowdfunding. On the other hand, if you're looking just to get support at this stage, you can go for incubators, you can go for co-working spaces, accelerators. Those are the kinds of spaces that provide the support or the mentorship for early stage entrepreneurs. If you want both, on the other hand, and of course, this is very simplistic, but if you were looking for a little bit of cash, typically you would go and talk to angel investors. If you're looking for a lot more cash, you would go for the venture capital firms. And if you kind of need both cash and support, but more support than cash, then accelerators are probably your best bet. So just very simplistically, those are kind of the different avenues that you can take for your needs at different points in your early stage journey. So before you pitch to an investor, I want to point out 3 important things that you should keep in mind. First, whether it's a venture capitalist or an angel investor, always do your research. Research them to find which ones are most aligned with your business. Some venture capital firms, for example, only invest in business to business. Some only invest in specific geographical regions. So it's really good to be prepared to go in, to having done your research, and also to have the leverage to know what you want and to look for the kinds of investors that align with your needs and what you're looking for. In terms of your pitch, it should include the vision. It should include the traction, the validation, the market opportunity. Make it very clear that there's a market opportunity, what the market looks like, the size of the market. Be very clear on the problem. And we see this more often than not, where entrepreneurs have a vague understanding of the problem, but they're not very focused. They don't really know what the exact focused problem that they're trying to solve. It's really important for us to see that you have a very focused problem, that you know what you're going after. Of course, you have to pitch and talk about your product and solution. Make very clear what your revenue model, your pricing strategy is going to look like. Talk about your marketing, your growth strategy, your go-to-market strategy. Team is something very important for early stage investing. We definitely put a lot of weight on who the founder is, what experience you bring to the table, why why it makes sense for us to put our money in you as opposed to any other team. So it's really important to highlight the expertise that you have in your team, also the board of advisors or board of directors that you currently have. Also, we want to see very clear financial projections. We want to see very clear defensibility, the competition landscape, that you have a plan for how you're going to be protected, whether you're going to pursue IP or other methods to have a moat. And then your investment ask. You want to see what exactly are you trying to get out of this conversation. Of course, you want to detail how much capital you're seeking, how much capital has already been invested in your business, and how you plan on using the funds. That's very, very important, actually. So before I move into bootstrapping versus investor funding, I want to go ahead and see if there's any questions from the audience. I don't see any questions in the chat, but if there's any questions, please feel free to write them down. Okay, so when should you consider bootstrapping versus getting funding from investors? So very high level, bootstrapping has a lot of pros and cons, just like investment funding does. From a high level, bootstrapping can provide you with the full decision-making freedom and control over your company. Also, as a founder, you're gonna own a little money, but you're gonna have it in hand. You're gonna have full focus on the business, on the product. You don't have to worry about fundraising and talking to investors. You're gonna be able to spend your money wisely. However, from a negative perspective, you're gonna be required to reinvest your profits that are earned. You're gonna have likely slower growth than you would if you were getting funding from investors. Not every business can be bootstrapped, so you really need to do your research and understand for your situation whether that will be a viable option. Competitors with better funding have usually a better chance in the market because they have the more credibility. And then from an investment funding perspective, the pros are usually that you're getting external support to grow. So that's a huge value add from VCs or angel investors. They're willing to give you mentorship. They're willing to give you connections. So it's a plus to have. Also, high profile investors usually give you extra credibility as a venture. Also allows you to grow faster. Gives you skills and experience. So you're going to get a very wide pool of skills and experience within that investor community. And then you're not going to need to repay that money that's invested. You only need to pay it with equity. As for the cons for investment funding, sometimes there could be misunderstanding between the founders and the investors. There could be also loss of control over the company. There could be various restrictions about payments, about equity, involvement in decision-making. Founders could own a small portion of a bigger pie. And then there could be less financial discipline as an outcome. So what are the odds or the percentage that's likely for a startup to become a unicorn? So if we take a look at the venture capital funnel, and this is just based on a cohort of companies that have raised seed in 2008 and 2009. So this goes from the second round to the sixth round. The second round being Series A, the sixth round being, much later than that. So typically 40% of companies that raise Series A fail to raise. So they're not able to successfully find funding. 14% of those companies are able to exit at that point. And you're going to notice that the more advanced the more advanced the stage or the round of funding, the less or the more likely they're going to be able to succeed in raising. So you're going to see the percentage of failing to raise goes lower and lower in the more advanced stages. So to answer the original question, 1% of companies actually reach unicorn status, companies like Slack, Uber, or Airbnb, and 70% of companies are going to be dead or self-sustaining. It's just the reality of the funnel. So what are some examples of why startups fail? Some of the top reasons why startups fail are that there are no clear market need. Again, market is really important. You need to validate that there's a clear market opportunity. Some companies run out of couch. Others don't have the right team. Some get out-competed. Some have pricing or cost issues. They're just not cost effective. Some validate that the user just didn't find the product to be very friendly. So there's a problem with product market fit. Some have a product that doesn't have a clear business model. Some have poor marketing. Some ignore customers. They don't really have IP or protection. Some just are mistimed. It's just the wrong time. Some lose focus. Some companies have disharmony among the team and investors. So again, it's really important that you are aligned with the investors that you have on board. Some see that their pivots have just gone bad. Some companies just lack the passion, they lack the motivation, the energy, what it takes to really get a company going. Some companies fail with geographical expansion. And finally, some companies just don't get financing or investor interest. So what are some of the investment qualifiers or disqualifiers for venture capital funds? I'm going to be very transparent and share some of the diligence qualifiers and disqualifiers that North Coast Ventures looks at. So we really classify companies based on three things. Those are market, product traction, and the team. From a market perspective, we want to see a very clear market opportunity. We want to see the value proposition associated with the problem. We want to see a large market, typically $1 billion TAM. We want to see high growth potential, so companies that have potential high annual revenues of $10 million or more within the next 3 to 5 years. From our perspective, we invest primarily in business-to-business SaaS. We want to see that it's well-timed and aligned with the secular industry trends. We typically like to see that the company doesn't really require network ubiquity or situational ubiquity. We want to see that we can be leveraging the regional strengths. So because we have such a large network of investors, we really want to see that we are able to add value to those companies. And then some of the red flags that we don't invest in are, for example, hardware, government clients, unproven platform dependencies. So it really varies fund to fund, but that's just some of our red flags. From a product perspective, we don't want to see an invention. We want to see a very strong return on investment. So typically we want to see it be an oxygen, something that's needed, not something that's nice to have like aspirin or jewelry, something that drives top line sales growth as opposed to cost savings. We want to see companies a little bit past the pre-revenue, so they have a little bit of revenue, minimum signals of product market fit. We want to see proprietary technology, influential reference customers, and very compelling unit economics. From a team perspective, and that's something we really put a lot of weight on, we want to see a very strong team DNA. We want to see the founder be very coachable, that they've had previous experience leading businesses or doing sales or product development. We want to see that the team leader has the capability to attract talent and capital. We want to see the evidence that they're understanding and tracking key business health metrics. We want to see a very reasonable valuation. And then just kind of a demonstrated commitment of the founders in the company. So it really varies fund to fund, but some of our most important scorecard items are highlighted here. Others that are important but probably not going to break it or make it for us are over here. So it really just varies fund to fund. But again, market opportunity is really important for most VCs. Clear value proposition, and then the team. We put a lot of weight on the team because, quite frankly, when it comes to an early stage company, the business model can change, the product or the offering can pivot, but the team can't change. So we put a lot of weight and have in investing in investors and founders that are going to be coachable, that have expertise, that have the right connections, and we put a lot of weight on that. So many of the most successful startups were funded by angels. You might not know this, but Apple, Google, Facebook, Uber, Amazon, they were all funded by angels. So if that's been the case, then why aren't more angels in the asset class? Well, startup investing is very risky. It requires diversification. Also, getting access to great deals is very challenging. And there's a very strong need for diligence and value add, which is very essential for VCs and angel funds. So to elaborate on the first point, you can see here just the distribution of US venture funds. You can see just on the y-axis, the percentage of financing. On the x-axis, it's the gross realized multiple range. So really, on average, 80% of VCs returns come from 20% of investments. And we've seen examples really where only one, for example, investment brought 80% of the returns. So it could be skewed depending on just how large that multiple range is for those few investments. But typically VCs are kind of aware that a lot of their investments are going to be in that 0 to 1x, the 65%. It's just going to be, there's not going to be very high returns or not returns at all. And very, very few are going to yield very high returns above 10%. So it's a risky game, but although there's a lot of chance of losing your money, there's a big chance for very high returns. The second point is getting access to good deal flow is very challenging. So if we look at it from a funnel perspective, typically, we see companies that we are aware of, typically companies that are within our investment thesis. Then we've got companies that we do have a personal direct contacts with. From those, there's only a small pool that we actually would be interested in investing in. And then from those few, there are only a few companies that actually are aligned in terms of the time, in terms of our diligence process, timeline, and their timeline for fundraising. It's all aligned. And very few companies we are actually willing to invest in, and they're willing to have us on their cap table simultaneously. So you've got a very large funnel. Very few are actually, within your thesis, very few are actually going to be the prime time for you to invest in, and they're willing to have you on their cap table as well. And then from there, you take them to the investment screening committee and do due diligence on them. And so very, very few end up being very good investment opportunities. The third point is that strong due diligence and value add is just critical. The stronger your members, the stronger your network, the more you're able to do a very robust due diligence process. And so the more also game-changing your value add is to your portfolio companies. So typically, we, as VCs, we put a lot of focus on who our management team members are, but also who are the subject matter experts that we pull in for different investment opportunity evaluations. For North Coast Ventures, for example, we actually actively engage our members in the process. So we very much rely on their expertise and their networks. And from the pictures that you're seeing here, we have an excellent group of investors who are, experienced founders who have led big companies, who are lawyers, finance professionals, you name it. So we've been very fortunate from that sense. So if investing in startups is so hard, why do angels do it? To be quite frank, a lot of it is for the learning, for the sake of meeting great people. It's quite fun. You get to give back to the community. And then also for the capital, of course, you're able to make high returns on those few investments. So I'd like to talk a little bit more about North Coast Ventures, and I know we're running out of time, so I'll make this pretty quickly. So North Coast Ventures leverages an active network of domain experts and corporate connectors to build great companies. North Coast Ventures invests in highly scalable business-to-business SaaS ventures that are focused on solving big problems, where our membership and network can provide domain and functional expertise. And our strong relationships with regional corporations drive added value and lead to market-making reference customers. We've really cracked the code on how we win. We've got an enhanced deal flow, which has attracted highly scalable business-to-business SaaS companies. We've also, we have an in-depth industry expertise from this huge network of around 250 investors who provide, expertise wide-ranging from all sorts of industries, all sorts of, business backgrounds. And then we've got game-changing connections, whether that means our members, our subject matter experts that we're connected with, or our corporate sponsors who provide, voice of the customers for a lot of our portfolio companies. So just as an example, we've been here for 14 years. We've had 5 positive seed fund exits to this point, the largest of which was 7x. So again, it really, it's very rare to see very high returns in a portfolio, even if we have 53 portfolio companies, 38 of which are currently active. So as an example, just from us, we've seen 5 positive exits to this date after 14 years. And that's just very typical for an early stage venture capital fund. We have 2 types of funds that we invest in. We have one that's seed fund, one that's acceleration fund. If anyone's interested, I can share more information later. And something that we actively do is we really try to support our portfolio companies. So, for example, with the recent COVID, we've put together this heat map to be able to support our portfolio companies and evaluate them based on these different metrics. And we really are trying to prove that the Midwest unicorn is not a myth. And we've seen from 3 of our portfolio companies, Remesh, ScriptDrop, and Performix, amazing growth just in the past couple of months. Actually, those percentages are indicative of that. So really quickly, path to VC. A lot of people ask me, is there a straightforward path to working at a VC? There really isn't. You can come from a background for working at a startup. You can be an ex-entrepreneur. You can be, like me, an engineer. You can be a doctor. You can be an investment banker, somebody who worked at Wall Street. It doesn't matter. It really matters that just you're very passionate and interested in taking that path. So my path, just really quickly, I came from Amman, Jordan. That's my home country. I went to Smith College, which is a small liberal arts school in Western Massachusetts. I majored in engineering. After graduating, I worked at Biomotive, where I helped support their portfolio companies. Biomotive is a biotechnology accelerator here in Cleveland that's focused on commercializing early stage companies. And then from there, I was very passionate about innovation, entrepreneurship, accelerating companies. And so I found myself at North Coast Ventures, where I'm currently at. Been there for 6 months and primarily support their deal flow, due diligence process, and then supporting portfolio companies. So what do VCs look for when they hire? They look for passion for innovation and startup success. Really, it's the entrepreneur DNA. They look for somebody who's a self-starter, somebody who can wear different hats, somebody with strong communication skills, somebody who's professional, is able to ask really good questions. Obviously, transferable skills and experience, somebody who's done deal flow sourcing, has supported portfolio companies, has experience doing due diligence. and most importantly, a strong desire to help others and be a connector. What does working at a VC look like? No investor has walked around as a little kid saying that they wanted to be a VC when they grow up. I think the job can be glorified through shows like Shark Tank. We really don't just listen to pitches all day, every day. We're very much inundated by fundraising calls, by requests, by emails, event preparations, pitches, portfolio problems, investor issues, and operational needs. We actually are ourselves like a startup, just more on a macro level. Instead of living and breathing the details of one company, we do it across a portfolio. And it's really important that you do this for the right reason. You want to be able to help build companies, you want to be a connector, and you want to be able to look for and find the next big things. Some of my book recommendations are these three. Venture Deals is a Bible in the industry. I would truly recommend all three if you have the time to read them. And I would truly also encourage you to watch One Crucial Thing, which is an event that we put together a month ago. We had a great lineup of top entrepreneur speakers, so very much encourage you to watch it when you get the opportunity. And last but not least, if you have any questions, if you'd like to connect, if you would like to ask me more questions, learn more about North Coast, if you are an entrepreneur or an aspiring entrepreneur, please don't hesitate to contact me. My contact information is here. Feel free to connect with me on LinkedIn. And I'm looking forward to hearing from many of you. Thank you for being here and for listening. Any questions? I see. What is your favorite part of being in VC? Honestly, being very young, I'm 23 years old. I feel very privileged to have this opportunity. I would say a lot of it is exposure. My network has expanded just significantly in the past 6 months. I get to engage with entrepreneurs, some of the smartest people. I get to engage with our investors, who are some of the smartest people in Ohio. So I feel very privileged to have this amazing network, to have the exposure that I do, and quite to honestly, just be able to ask questions all day. Like, what I do is I screen companies, I engage with entrepreneurs. I'm able to ask them questions and really work on the art of asking good questions. So I think that would be my favorite part of working in VC. Any other questions? I know that was very fast. I hope that it was helpful. But again, feel free to contact me if anyone has any questions. I'm looking forward to hearing from you. All right. Well, I think my time is up, but thanks so much for being here. Thank you a lot. And I hope to hear from you.